Welcome back, everyone, to the channel of the Millennial Messiah, and we are continuing with our reading from the book The Lords of Easy Money. We are on chapter 11, The Hoenig Rule, so let us continue without further delay. After Thomas Hoenig left the Federal Reserve, he was not rewarded with a relaxing retirement. Instead, he was invited to move to Kansas City to Washington, D.C., so he could take one of the most difficult and thankless jobs in that city. He would help run the government agency that tried to keep the financial system stable, even amid rising debt and risky investments. To make matters worse, he arrived in town with a highly detailed plan to break up the big banks. It started back when Hoenig was still president of the Kansas City Fed. He got a call from a U.S. Senator staffer who worked for Mitch McConnell, the Republican Majority Leader. The staffer asked Hoenig if he knew anyone who might be interested in becoming a commissioner for the Federal Deposit Insurance Corporation, or FDIC. Hoenig said he would think about it. The staffer later called back and asked if Hoenig, maybe himself, might be interested. I said, "Well, there's always a chance I might be interested," Hoenig recalled. During one of his regular trips to Washington, Hoenig stopped at the Capitol building for an official job interview with McConnell's staff. Hoenig said he would take the job, but he wouldn't join a political party. After decades of working at the Fed, Hoenig wanted to stay within the ranks of an independent agency to remain outside party politics. This worked for McConnell's staff. Hoenig was nominated and approved by the Senate. The FDIC seemed like a perfect fit for Hoenig. The agency was created during the Great Depression with a sweeping mandate to regulate banks and protect the banking system. The agency is best known for ensuring the bank accounts of everyday people if a bank fails. The FDIC will cover the losses of anyone who has money at that bank up to $250,000. The average U.S. family had about 40,000 in total savings in 2016. The agency also examined the bank books to make sure they had enough money to meet their obligations. The agency played a central role in determining the shape and structure of America's banking system, and therefore its entire social system. Hoenig took the job in part because there was urgent work to do regarding America's big banks. Even years after the financial crisis had ended. One of the strange side effects of the global financial crisis was that it entrenched the power of the big banks that it helped create. The banks that were too big to fail in 2008 were now bigger and even less able to fail. The banks controlled far more of the nation's assets than they had ever controlled before, and the federal government seemed intent on keeping things this way. This was something Hoenig had been talking about for years. The number of community banks in America was falling by the thousands, while the assets held by a small group of very large banks got larger. The industry was becoming more consolidated than any time in modern history. At exactly the same moment, the Fed was encouraging these banks to take on more risk. The risk was also spreading into the shadow banking system, where hedge funds and private equity firms were taking on bank like functions of lending huge amounts of money. Everybody knew where Tom Hoenig stood on this issue, and he didn't surprise anyone when he arrived in Washington in 2012. Almost immediately, he went on a speaking tour. He accepted gigs to speak at high end banking and regulation seminars around the Capitol. Back in 2006, Hoenig had shocked a group of bankers into silence after he had spoken at their gathering in Tucson, Arizona. He seemed to be making a cottage industry of doing the same thing in Washington. His speeches for the FDIC followed a broad theme. He argued for the need to reshape the banking industry with an eye toward simplicity rather than complexity. When speaking to a crowd of bank regulators, Hoenig said they would tear up at the very complicated rules they'd been negotiating for years, called the Basel Third Accord. When he spoke to a group of bank lobbyists and journalists, he told them the banks should be broken up rather than regulated and monitored under the new Dodd-Frank Act, which was roughly 850 pages long. This approach was considered radical in the political environment of 2012, but Hoenig wasn't irrational to the pursuit. He had been selected for this job by one of the most powerful Republicans in the country, and his selection had been approved by the sitting Democratic President Barack Obama. During the entire process, Hoenig's views were well known and transparent. He didn't just advocate breaking up the big banks. He had written a detailed blueprint on how to do it when he was still president of the Kansas City Fed. When Hoenig arrived at the FDIC, he believed there was a real chance for reform. Hoenig was the number 2 official at the FDIC. The chairman, Martin Gruenberg, was a longtime Democratic staffer who seemed open to the idea of constraining the bigger banks. But very early on, the warning signs were evident. During Hoenig's confirmation hearing, a senator, Republican named Bob Corker, mentioned that Hoenig's nomination was already causing tension. Corker was supportive of Hoenig's appointment, but Corker said he had been getting phone calls from some of the larger institutions that were well aware of Hoenig's earlier comments about too big to fail banks. Some of them are concerned, Corker said. Hoenig was called before a Senate hearing in May 2012 to outline his plan to break up the big banks. Corker was nonetheless enthusiastic about the plan. He called it the Hoenig Rule. If there was enthusiasm for the Hoenig Rule, even among conservatives, it was fueled by the unsatisfying series of compromises on bank regulation that had been put in place after the crash of 2008. The banks had been allowed to remain as if they were, but would be subject to new rules that would modify their behavior. This was in stark contrast to what the government had done during the Depression, which was the most recent comparable bank crisis. The Roosevelt administration and Congress had passed laws that redrew the shapes of banks in a way that constrained their powers and the risks that they could pose. The Obama administration took a different approach. It is true that Congress passed bank reform laws and even created a new regulatory agency called the Consumer Financial Protection Bureau that had a real impact. But rather than restructure the banking system, the government chose to create a hyper dense web of new rules that would be layered over the big banks, allowing them to remain big but subjecting them to scrutiny and micromanagement. It was the regime spelled out in hundreds of pages of the Dodd-Frank law in the United States and the International Banking Agreement called the Basel Third Accord. Hoenig argued that this was a losing game. He said that bank rules needed to be simple in their aim, easy to understand, and straightforward to enforce. He argued that the banks should be broken up again, as they had been under the New Deal. Banks should once again be divided up by their function, with commercial banks handling insured customer deposits, while other banks did riskier things like trade derivatives contracts. This division would help ensure that taxpayers were on the hook only to ensure deposit at commercial banks, which would still be covered by FDIC insurance, instead of extending that safety net to mega banks that held deposits and also engaged in riskier speculation. Once the banks were broken up, Hoenig believed they needed to live by simple rules that determined how much capital they should keep on hand in case of an emergency. The key idea behind the Hoenig Rule was breaking the riskier parts of banking away from the economically vital parts, like making business loans, so that the riskier banks could fail without taking down the rest of the system if they made bad bets. The financial columnist Alan Sloan wrote for Fortune, and the Washington Post published a widely read column after Hoenig's Senate hearing that said that Hoenig's rule is exactly what Wall Street needed. It's so simple. It's brilliant, Sloan wrote. It's a smart decision of high risk from low risk activities. With this support, Hoenig kept pushing. In September 2012, he was invited to speak at the exclusive Ecker Club in Washington, an event attended by bank lobbyists, bank regulators, and the financial press. A certain etiquette was usually recognized at events like this, and Hoenig respected it to a degree. His speech was laden with technical language and the bloodless prose of a good financial bureaucrat. But what he said was still shocking and rarely spoken on the high end financial speaking circuit. He began by saying the financial reforms of 2009 and 2010 hadn't gone nearly far enough. The banking system was still a threat to the American economy and it needed to be broken up. Even if most people thought the era of bank reform was behind them. But the need to reform banks went beyond the need for financial stability. Hoenig said that the reform was a necessary thing to restore trust in the banking system. Side note, personally, I don't think there is trust in the banking system anymore. At least, not in today's world. I definitely don't trust the banking system. Alright, back to the reading. That trust can be reestablished and accountability can be put back into the system so that the banking industry can win without the rest of us losing, Hoenig said. Even during this speech to a banking crowd, Hoenig talked about the Hoenig Rule in a way that was bigger than just financial regulation. He believed that the rule would stabilize banks, but he also argued that it would accomplish something beyond that. Restructuring the banking system was a crucial step towards repairing some of the deeper scars that had been left behind from the crash of 2008. It would repair the kind of damage that Hoenig had seen firsthand when he was invited to talk to the Tea Party groups in Kansas, or when he met his old war buddy John McKeon for lunch. The financial crash had drained the reservoir of Americans' faith in their own governing institutions. If that faith wasn't restored, the results could be widely destabilizing. How could we possibly convince Americans that the financial steps will be equitable when we bailed out the largest banks and yet they remain larger, more powerful, and insulated from the market's discipline? He asked during the talk at the Ecker Club. There was bipartisan support for this view. Corker wasn't the only senator who expressed enthusiasm for Honig's ideas. Hoenig had lunch twice with Senator Elizabeth Warren of Massachusetts, a Democrat, whose entire career was built on tougher regulation for Wall Street. Warren supported Hoenig's ideas vocally, as did the Democratic senator from Ohio, Sherrod Brown. Hoenig believed his plan was viable. When I showed up, I thought maybe I could convince people that it was an option, he said. His education to the contrary came quickly. Hoenig made his rounds on Capitol Hill, visiting senators who could play an important role in pushing any bank reforms. After sitting down with one senator, Hoenig was on his way out of the office when he saw a prominent banking lobbyist walking in to meet the same senator right after him. I was coming out of one door and I recognized him, and he was going in the other door, Hoenig said. He wasn't surprised. He knew that bank lobbyists would be making the rounds as well. That's their right. I don't have an objection. I just kind of laughed at it. The bank lobbyists were numerous, persistent, and engaged on Capitol Hill. They had their own think tank called the Bank Policy Institute that churned out high quality studies and white papers to promote the banker's point of view. This made it hard to break, though. Look it, a senator only has so much time, Hoenig recalled. So they have to try and stay up on the issues and so forth. If you have 15 lobbyists for the industry and 2 lobbyists for the public interest groups, or the agency that is proposing to tighten up on the regulatory standard, who's going to present the arguments most? Hoenig visited the senators, and the senators smiled politely, and the bank lobbyists came right in after him. He eventually realized that the Hoenig Rule was a dread letter. It was never going to happen. The course had been chosen in 2010 when Congress passed Dodd-Frank, which had been a bitter political fight. Congress was tired of working on this issue, Hoenig recalled. I fully understand it. Dodd-Frank was a huge lift to get done, but they made a decision to go in a direction that rather than to go the way of breaking up the big banks. The very complexity of Dodd-Frank, while vexing for the banks, became helpful to the biggest institutions. The law spawned about 400 new rules, and each new rule became a small regulatory quagmire of battles as it passed through a long process to become finalized by agencies like the FDIC. This gave the banks numerous chances along the way to dispute every detail of the rules. One rule, on the regulation of derivatives, received 15,000 public comments. Some agencies were so overwhelmed that they missed deadlines to put the law into effect. By 2013, only about one third of the law's rule had been implemented. The banking system didn't let up. It spent about 1.5 billion on registered lobbyists alone between 2010 and 2013, a figure that didn't include the money that went into public campaigns or think tank papers. The Dodd-Frank system tried to manage the risk inside big banks while allowing them to grow bigger. One of the key ways it did this was through something called a stress test, a procedure championed by Obama's Treasury Secretary, Timothy Geithner. The stress tests required banks to pretend that they were facing a crisis and then to explain in writing why they would survive it. To pass a stress test, the banks had to prove that they had enough capital on hand to cover losses during hypothetical crisis. But this was just open and made for a lot of debate over what counted as capital and what even was counted as a crisis, and became a never ending negotiation that hindered and hinged on speculative arguments about how well the value of an asset like a CLO might hold up under hypothetical market conditions. A second lesser known procedure was something called a living will, which was essentially a document that the banks produced to prove that they could indeed fail without bringing the entire financial system down with them. They had to prove that they could die without a bailout. This also turned into a tedious negotiation, and Tom Hoenig was in the middle of it. In 2013, the big banks submitted their living wills, which ran to thousands of pages, to both the FDIC and the Federal Reserve. Hoenig and others at the FDIC were not impressed. The banks were telling a story in their living wills, and it wasn't convincing. Hoenig argued that the banks needed to redo the documents with more detail, explaining precisely how they'd be able to close down without government bailouts. The regulators gave the banks more time to do this, and the process dragged out for years. The banks submitted new living wills, and those wills were again rejected in August 2014. In July 2015, the banks resubmitted their plans. In April 2016, the living wills were rejected once again. The process continued. One group of people who seemed to have zero faith in the living wills were the Wall Street traders. In these circles, there seemed to be no pretense at all that living wills were anything more than political theater. The Democratic chairman of the FDIC, Martin Grunberg, launched a public campaign in 2012 to convince people that the FDIC would actually let the banks fail. Nobody seemed to believe him. When asked about this process, Cornelius Hurley, director of the Center for Finance, Law, and Policy at Boston University, told American Banker magazine that markets are convinced that in the next crisis, the too big to fail banks will be bailed out just like they were in the last one. To be specific, the banks that had to have enough ownership capital funding, as the regulators called it, meaning capital was provided by owners or shareholders, which is permanent to the bank and can't be used to absorb losses. Loans don't count as this kind of capital because loans have to be paid back. There was a reason that the banks fought so hard for the living wills to be accepted. If the wills were rejected, the FDIC could require the banks to do something they had resisted doing for years: put more capital aside to cover losses in a time of crisis. This was the issue that Hoenig began to focus on when he realized the banks were not going to be broken up. The big banks were getting bigger. Regulators could at least insist that they put aside enough money to withstand big losses in a downturn. This problem had supposedly been dealt with by the passage of the Basel III Accord, the international agreement on banking regulations named after the city in Switzerland. Like Frank Dodd, Basel III tried to use complexity as a way to make banks safer without breaking them up or restructuring them. Basel did this by creating an accounting system under which the banks could report how much hard capital they had on hand, compared to the amount of assets on their books. The banks had to show that they had enough reserve capital to cushion the blow when asset values crashed during a downturn. This seemed simple enough, but Basel let the banks use a risk weighted formula to determine the value of their assets for regulatory purposes. Under that formula, a bank might be able to say that it didn't need to hold any capital against the debt of nations like Greece because government debt was considered so safe. It was such decisions that made Basel unworkable, in Hoenig's view, and that made the banking system appear safer than it was. Risk based capital measures are highly complex. Highly complex. There's no one that understands them. Even the companies themselves, at least the CEOs of those companies, often do not understand what goes into it, Hoenig said. They give you a sense of safety that isn't real. Hoenig tried to cut through Basel's complexity in a very public way. He created something called the Global Capital Index, which the FDIC started publishing regularly. The index was really just a glorified spreadsheet, but it told a shocking story. One row of numbers showed how much capital the big banks had on hand under the Basel III standards. Usually, these numbers were reassuring. JP Morgan Chase, for example, reported in 2013 that its capital ratio under Basel III was an impressively fat 11.94%. But Hoenig's spreadsheet went on to show how much capital the banks had on hand under a more traditionally used measure called a leverage ratio, which didn't use Basel's risk weighting. Under that standard, JP Morgan had only a 6.22% cushion. When you applied international accounting standards, things were even worse, with a mere 4.22% cushion. Hoenig used the Global Capital Index as a type of perpetual irritant, reminding everyone that the banks probably didn't have enough money on hand to face another major downturn. When Hoenig argued for tougher capital requirements, he was joined by influential allies like Sheila Bair, a former Republican chairwoman for the FDIC. Somewhat surprisingly, Hoenig and Bair ended up on the winning side of the argument. The United States created its own capital requirements that were more strict than those laid out by the Basel III Accord. Still, by 2016, Hoenig believed the U.S. banking system was fragile and susceptible to crashes that would necessitate more bailouts. Hoenig believed that the banks needed a cushion of about 10% of their total assets. He used a metric for bank reserves called tangible capital, meaning hard capital that the banks could use to pay for losses. In 2007, before the banking crisis, banks had tangible capital worth about 3% of their total assets. By 2016, the tougher U.S. standards pushed that ratio up to about 5.5%, meaning a meaningful increase that made U.S. banks safer than the European banks, which enjoy a looser standard under Basel. The reason Hoenig was still worried was that losses hadn't surpassed 5% at many banks in the 2008 crash, and banks didn't need to lose all of their capitals to need a bailout. If a bank lost just 3%, investors might question how much more the bank could lose before it failed. At that point, they might pull all their money out, which would lead to a panic. Hoenig spent much of his time in debates over this issue, sending letters to senators and arguing that having more capital on hand didn't cripple a bank, as many argued. It made it stronger. These kinds of fights defined Tom Hoenig's career as a vice chairman of the FDIC. He argued that the banks needed to be limited in their reach, required to hold more capital, and less assured of taxpayer backed safety nets. Hoenig was praised in various corners, from Senator Elizabeth Warren on the left to the Wall Street Journal editorial page on the right, but his views never gained much traction in Washington. As far as Hoenig fought, he was still fighting a rearguard effort. As the FDIC worked to constrain the banks, the Federal Reserve was pushing in the opposite direction. Between 2007 and 2017, the Fed's balance sheets nearly quintupled, meaning it printed about 5 times as many dollars during that period as it printed in the first 100 years of its existence. All those dollars were forced into zero interest rate world, where anybody was punished for saving money. It was important to trace the path of each EQ dollar released in the flood of 3.5 trillion. The dollars were like drops of water added to a swimming pool, merging instantly with the broader whole. But the level of the pool could be measured. The McKinsey Global Institute, for example, determined that the Fed's policies created a subsidiary for most corporate borrowers worth about 310 billion between 2007 and 2012 alone. By pushing more money into corporate bonds during that same period, households that tried to save money were penalized about 360 billion through lost earnings on interest rates. Pension funds and insurance companies lost about 270 billion during that time, and that was just the beginning of the ZERP era. This money flowed out into the system, and it pushed all the major financial institutions to search for yield. Many Wall Street traders clearly saw what was happening, and they developed a quick name for it: the everything bubble. The Fed's policies created such an intense and broad based search for yield that the risks were building up all over the place. The search for yield pushed money into corporate debt and stocks. By the end of 2018, the US stock market for CLOs was about 600 billion, double the level a decade earlier. Banks in the United States held about 110 billion. The banks believed that their investments were ultra safe because they bought only the safest tranches rated AAA. The high demand kept corporate debt cheap, so that more and more companies were induced to borrow. The demand for loans reduced the scrutiny that was applied to them. Predictably, many corporate borrowers were overly optimistic when it came to estimating how much money they could earn. Fully 90% of all new corporate loans extended in 2016 would fall short of their earnings target. Oh, hey. According to a survey taken later by the ratings agency Standard and Poor's, companies had estimated that their debt would only equal about triple the amount of their profit before taxes and other costs. It ended up equaling about 6 times as much. The optimistic assumptions were overlooked. The money had to go somewhere. Quantitative easing was designed and initiated with the specific goal of inflating stock market prices. The plan worked. The value of stocks steadily rose during the decade after 2010. In spite of the weak overall economic growth, the broad based wage stagnation, and the host of international financial problems that the Fed cited just as justification for its interventions. The value of the Dow Jones Industrial Average rose by 77% between 2010 and 2016. One hedge fund trader, who was a bit more caustic by nature, described the frothy stock market of 2016 as being like the crowded deck of the Titanic as it sank. The deck wasn't getting crowded because it was a great place to be. It was getting crowded because people had nowhere to go. The search for yield pushed money into the oil industry. The money needed to find assets, and there was a gusher of assets pouring out of the ground in newly developed oil fields in Texas and North Dakota. The new oil drilling technology called hydraulic fracturing or fracking opened a wild and new frontier for the energy business. There was no limit to the optimism that sprang from entrepreneurs who pitched their fracking dreams to Wall Street. Money went flooding into fracking the country in the form of cheap corporate debt. By one estimate, oil industry debt tripled between 2005 and 2015, rising to 200 billion. In 2017 alone, the fracking industry borrowed 60 billion. In a theme of this era, scrutiny and skepticism were in short supply. The frackers presented a case for borrowing that was optimistic and to the point of delusion. This optimism centered on just how much oil each well would produce, which in turn would determine how quickly they could pay down their loans. Fully two-thirds of the production estimates made by leading fracking companies in Texas and North Dakota between 2014 and 2017 were inflated, promising more oil than what was ultimately delivered. According to an in-depth investigation by the Wall Street Journal, the estimates were, on average, about 10% too high. It didn't take a forensic accountant to realize this. The frackers lost money in a large and very public way. Between mid 2012 and mid 2017, the biggest fracking exploration and production companies had a collective negative cash flow of 9 billion every quarter. And still the money flowed to them in the form of corporate bonds and leveraged loans. Ares Capital, one of the new breed of business development companies that bundled and sold corporate junk debt, arranged loans for companies throughout the oil belt. The belt was extended to obscure companies with shaky financials to which traditional banks avoided lending. They borrowed millions of dollars at interest rates of about 10 or 11%. Wall Street investors didn't give the frackers money because the investors were stupid or because they believed wholeheartedly in the future production promises. They invested because the Fed was incentivizing them to invest. Thousands of wells were drilled all across the country. The search for yield pushed money into commercial real estate. In 2013, A bond analyst named John Flynn was preparing for a wave of mortgage debt failure. He called this apocalyptic moment the Wall of Maturities. The wall he had referred to was the moment when billions of dollars in commercial real estate bonds extended during the real estate bubble of 2006 were set to mature. This would be a moment of reckoning for the commercial real estate industry, spelling doom for irresponsible developers who borrowed money to build shopping malls, office parks, and factories when they had no realistic way of repaying the loans. This debt had been packaged up and sold as something called commercial mortgage backed securities, or CMBS. Finn had worked around CMBSs for most of his career. He created and sold them. He rated them for a rating agency, and he was eventually able to start his own company to advise investors about them. This was why he knew about the wall of maturities. Between 2005 and 2008, billions of dollars worth of CMBSs had been created with absolutely horrible underwriting standards. It was a lot like the home loan bubble, but it hadn't imploded yet. This would happen on a rolling basis between 2014 and 2016 as bonds came due and either had to be repaid or roll over. But a strange thing happened. Nothing. There was no wall. There was no carnage. Only a tiny handful of CMBS bonds went belly up. Flynn was caught up short. I wasn't the only one in the market expecting this, right? Flynn recalled. I know shops that hired 40 people to handle the onslaught of maturity defaults, but it never happened. This nagged at Flynn. He knew that the underlying loans in the CMBS market were rotten, and not only were these loans not defaulting, lenders were packing and selling new batches of CMBS bonds. Flynn went to his brother's cabin in Minnesota where he could do research unbothered. He downloaded the very dense CMBS prospectuses, which describe loans inside a CMBS. He read the very detailed financial information about the borrowers, including how many units were for lease in a given office building. All this detail added together measured the profitability of the underlying commercial real estate property. Then Flynn looked into a separate database that tracked actual cash flows for commercial properties going back years. He downloaded this data and compared it to the information inside the CMBS prospectuses. These data sets were the opposite of user friendly. That's why I took so much brain damage to get to it, Flynn said. I was constantly cutting and pasting and inputting into new Excel sheets and combining that and with the prospectus information. Eventually, he was able to build a database that compared the actual profitability of a commercial properties with the profitability that the banks advertised in their CMBS prospectuses. My jaw dropped, he said. The numbers were being inflated. Banks were reporting profits in their CMBS loans that were constantly higher than the figures Flynn obtained through independent databases. The profit figures were inflated by as much as 30% or even 65%, depending on the CMBS bond. Flynn could think of no explanation for this inflation other than fraud. He contacted lawyers, spent months polishing his data, and then filed a whistleblower lawsuit with the Securities and Exchange Commission in 2019 that accused 14 large lenders of intentionally fudging the numbers to make the loans look healthier than they really were. Flynn's findings were later supported by two researchers at the University of Texas who studied about 400,000 commercial real estate loans worth a total of 650 billion originated between 2013 and 2019. The income figures on nearly a third of those loans were inflated by 5% or more. This meant that the properties didn't earn as much money as the lenders promised they did, even when the economy was doing well. If the economy ever stalled, these properties would be more vulnerable to the downturn. Roughly 76 billion in CMBS bonds was issued in 2018 and another 96.7 billion was issued in 2019. By 2020, the CMBS market was estimated to be worth about 1.4 trillion. If Flynn was right, then the banks were fraudulently boosting the income numbers inside the CMBS prospectuses. Than that dishonest behavior of the banks. The problem reflected the same thing that was happening with fracking bonds and corporate debt. Investors were desperate to find yield, so they didn't want to ask questions. And the investors were so desperate because the Fed was forcing them to be desperate. It's a self perpetuating cycle where they lower the interest rates, so you offer a minuscule yield on a secured note, and investors have to gobble it up no matter the underlying details. They have to gobble it up, Finn said. And in fact, they're incentivized not to look because they don't want to know what's under there. The search for yield pushed money into the debt of developing nations. When McKinsey Global Institute tried to track the flow of dollars created by quantitative easing, it discovered that billions of those dollars flowed to developing nations like Mexico, Poland, and Turkey. These countries were considered a bigger credit risk than the United States, so they had to pay higher interest rates to attract lenders. Turkey borrowed 6 times as much money by issuing bonds between 2009 and 2012 than it did between 2005 and 2008. That nation's president, Recep Tayyip Erdogan, used the borrowed money to finance a building spree, solidifying his power and helping push economic growth to an annual rate of 7% by 2018. The borrowed money helped construct new shopping malls next to old shopping malls in Istanbul. New condominiums, a new bridge, and a new skyscraper called the Sapphire were erected. Construction contractors borrowed roughly 56 billion thanks to bonds denominated in foreign currency. Even if the shopping malls remained largely empty, they still got built. The borrowed money created jobs, but the borrowing left nations like Turkey enormously vulnerable to any changes in the debt markets. When Ben Bernanke said in 2013 that the Fed might taper its quantitative easing program, the market adjusted immediately and investors started to sell off riskier government debt. About 4.2 billion of Turkish bonds were sold in the following 3 months. About 2.4 billion fled Poland. When foreign investors dumped their bonds, it damaged these nations by causing the value of their currencies to decline. The value of currencies in Turkey, Brazil, Mexico, and Poland fell by about 4 or 5% during the taper tantrum of 2013. Currency values are affected by a lot of different factors. Of course, Turkey and Brazil were already suffering some devaluation, but the link to the Fed's policies was unmistakable. When the Fed reversed course and said it would not taper after all, the value of currencies like the lira and the peso jumped by 2%. The demand for bonds in the developing world strengthened and the borrowing resumed. Finally, the world's central banks went further to push the search for yield, turning the very concept of yield upside down. That does not sound good at all, does it? Maybe the strangest creature that evolved during the era of ZERP was the negative interest rate bond. The term negative interest rate should be oxymoronic, meaning that an investor pays money to the borrower for the honor of lending to them. That the experiment in offering negative rate debt began in Europe after the financial crisis. Virtually no debt in the world offered negative rates until about 2012. The first bonds with a penalty rate were presented as an emergency measure. Countries like Sweden entered the market gingerly, with bonds that cost money to own each year. Sweden didn't charge much money at first. In 2015, the Swedish central bank, the Riksbank, dropped its interest rate to 0.1%. Other countries like Germany and Denmark did the same, as did the European central banks. The idea was that the negative interest rates would have the same effect as quantitative easing. Instead of incentivizing investors to reach for risky yields, the central banks of Europe literally punished investors. Financially speaking, who saved money. The negative bonds were supposed to have a quick effect and disappear. But then a very strange thing happened. Investors started lining up to buy these bonds. By 2016, they accounted for 29% of all global debt. About 7 trillion worth of bonds carried negative rates. The bond market is often considered to be the sober older sibling of the stock markets. And in 2016, this sober older market was sending out flashing red warning lights, indicating that things were not normal. Bond investors were so desperate to find a safe haven for their cash that they were willing to pay a fee to governments like those of Germany and Denmark to safeguard it. When the New York Times reported on the negative interest bonds in 2016, the paper interviewed Kathy A. Jones, a chief strategist at Charles Schwab Investments. "It's all upside down," Jones told the newspaper. "Negative interest is hard even to think about. Our whole financial system is built the other way, on positive interest rates. This negative 0.1% is mind-boggling." This was happening as Tom Hoenig was bogged down in long disputes over living wills and stress tests and capital reserves. Hoenig's office at the FDIC headquarters was large, sparsely decorated, and bathed in sunlight during the afternoon hours. There was a large wooden desk where he constructed his work, and next to that spacious sitting area with chairs to receive visitors. In August 2016, Hoenig seemed contemplative and sanguine, but he also seemed to possess absolutely no illusions about the limits of his accomplishments during 4 years in Washington. After all the fights and attempts at reform, the banking system remained too fragile to absorb a major shock, and the banks were still too big to fail. Now that the Fed had reshaped the financial markets, how could it ever withdraw its support? The world had to reorganize itself in ways that would be painful to undo. Think about it, Hoenig said. You had 7 years of basically 0% interest rates. Now, what happens in an economic system over 7 years? The entire market system develops a new equilibrium around a 0% interest rate. An entire economic system around a 0% interest rate. Not only in the US, but globally. It's massive. Now, think of the adjustment process to a new equilibrium at a higher rate. Do you think it's costless? Do you think that no one will suffer? Do you think there won't be winners and losers? No way. You have taken your economy and your economic system and you've moved it to an artificially low 0% interest rate. You've had people making investments on that basis, people not making investments on that basis, people speculating in new activities, people speculating on derivatives around that. And now you're going to just adjust it back? Well, good luck. It isn't going to be costless. So that was the end of chapter 11. So, especially as you can tell, that last line where it isn't going to be costless, boy, is that the truth. Because now, today, it seems like the banks are even larger than they were when this book came out. Let's see, this book came out in in 2022, so it came out 3 years ago. So the banks are even larger now. The largest being now is J.P. Morgan Chase. So everything is just being manipulated. Our money is being manipulated. The banks are manipulating things, manipulating their loan prices, manipulating their asset prices, lying about their asset price values, and basically lying to the American public who they are supposed to serve and protect their money, but they don't, and neither does the Fed, as we have been learning. The Fed has just been doing what it's been doing the last decade, which is printing more dollars every day and manipulating the markets and making our currency worth less and less every day. So, if you had any questions, please leave those in the comment section below, or if you want to just rant about how the Fed is destroying the value of the US dollar, you can do that too. Otherwise, please hit the like button on the video so that way it goes out to more people, and we will continue on chapter 12 in the next video, which will be totally normal. So that's that's the name of the title. A bit ironic, isn't it? But anyways, everyone, I hope you had a fabulous time listening, and have a good night. Bye.